to see if it's working okay. So the good news on chapter 12 is we're only going to be doing the first two objectives, okay? First objective is basically really understanding the statement of cash flow, okay? And then the second objective is actually about preparing a cash flow statement using the easiest method, which is called the indirect method. That's basically all we're going to be doing in chapter 12. So let's start off, first of all, with what the cash flow statement is and why it's useful to understand. First of all, you have to understand that this is all about cash, okay? And it tracks everything to do with cash in a business. And the cash flows only two ways. Cash either comes in or cash flows out. Okay, so you're going to see how it's just like if you get paid, when you get paid, that's cash coming into you. And when you pay your bills, that's cash going out. So you could prepare a cash flow statement for yourself as well, but we're looking at it from a corporate perspective. It looks at the company's ability to generate cash, which is extremely important today. I mean, that's one of the biggest problems in business today, is that there's not a lot of cash flow, and that's endangering a lot of businesses, both small and large. They need cash in order to pay dividends and to pay bills. Okay. Probably the trickiest part of all of this is understanding that there's a little bit of a difference between looking at net income, which is the profit of the company, and the operating activities that also are responsible for generating cash or using up cash in a business. That's going to take the most time, okay? And we're going to be doing a little bit less of the last piece, but that's an important part. Companies have to always keep their cash invested. Okay. I'm getting a little bit of noise here. I'm going to mute everybody so that can take care of that. All right. So we learned about the the three basic business activities back in chapter 1. The book in chapter 1 shows you about the three basic activities. The first one being, which is just the opposite order in chapter 1. So we talked about financing activities, right? Where do companies get money to buy things? And usually they get money either by borrowing money, so it talks about liabilities, or the owners put money in. So the financing tends to be, activities tend to be revolving around liabilities and stockholders' equity issues. We also talked about investing activities of a company. Overwhelmingly, we're looking at companies buying assets that help generate more profits in the future. So there's a lot of emphasis on investing activities with property, plant, and equipment. But companies can also hold investments. They can hold stocks, bonds, among other things. So I don't think it does them much good to do that, but they can. So those are also investing activities of a company. Also, an investing activity of a company could be, well, you'll see as we go, it could be a little bit different, including lending and making money off of that. Operating activities of a company are basically done through its operations, right? So the operating activities of any company only happen when the company's open for business. And so when it's open for business, what happens? Well, it's collecting revenue, it's paying expenses, and so oftentimes operating activities tend to be associated with income statement items. It's not exclusive to that, but it tends to be associated with that. What other things happen when the business is open? They're buying inventory, they're doing other types of things as well. But for the most part, income statement items, revenue and expense items tend to get done only when the business is operating. So operating activities are classified, all activities are classified in two ways. Cash coming in and cash going out, okay? So a cash inflow is simply cash flowing into the company. Okay? So how does cash flow into the company when you think about the operating activities? Well, when there are sales of goods and services, the company is usually collecting cash, and so that cash is coming in. If the company is receiving any interest on a bank account or something like that, that's also cash coming in. So cash inflows, again, cash coming in. These are the typical ones that we look at for operating activities. Cash outflow, again, cash going out of the company. Why would cash go out of the company? Oftentimes it's to purchase current assets or to pay bills. And so when they buy inventory, that usually revolves cash going out. When they pay salaries and wages, usually it's cash going out. Paying their taxes, cash going out. Paying interest on loans, cash going out. And any other type of expense. Overwhelmingly is your expenses you need to write a check for, right? So rent, other types of things, you're writing checks. And so other expenses usually require cash to flow out of the company. Investing activities are listed next. And again, here, the same, right? Either cash is flowing into the company or cash is flowing out of the company for investing activities. So what would be coming in to the company from investing activities? Well, again, if they sell any of their assets, particularly the long-term assets, property, plant, and equipment, they sell a building, they sell a piece of land, they'll be getting money in from the sale of that. So that's a cash flow inflow from the sale of that type of property. If they sell investments that they might own, then that cash is coming in from the sale of investments. That's also an inflow. And here's what I was mentioning earlier. Companies sometimes make loans to other companies. Right? A note is often from one company to another, can also be from a bank. But in this case, if our company made a loan to another company, that actual loan is, when it gets paid to us, when we collect it, is an inflow of cash. Okay, it's an outflow when we make it, it's an inflow when we collect it. Cash outflows are listed, and this is probably the most important part of what I look at for the investing activities, because one of the things that I want to see a company doing is purchasing more property, plant, and equipment so they can sell more of their stuff, right? That they can earn more revenue and thus earn more profit. And so usually cash outflows regarding purchasing of property, plant, and equipment is usually a very good thing for a company because it tells you, in essence, that they're committed to growing and expanding. And usually that means these businesses are profitable. But they also can purchase investments. They can purchase bonds, which is a debt security, or stock in other companies, which is an equity security. And so, of course, when they purchase that, that's cash going out. And like I was saying up here is when we collect the loans, that's an inflow. When we make loans to other companies, that's a cash outflow, but it's an investing activity because we are going to be earning interest on that, and it's an investment. We make the loan as an investment. Financing activities are any changes that usually happen in the liabilities and stockholders' equity, because that's the financing area, right? That's how we get money, right? So again, same thing here. Cash either flows in or cash flows out from financing activities here. So if we sell, if we issue shares of stock, right? We issue shares of stock to stockholders, and stockholders are putting money in for those shares of stock. That's a cash inflow. We could also issue debt, which is borrowing money, right? Issue bonds to investors. And when investors buy those bonds, that means we're borrowing money. That cash is coming in from that. Cash outflows work just the opposite again. When we pay dividends, again, dividends go to stockholders. And because it's going to stockholders, it's a financing activity. But in this case, the cash is going out to them. When we actually pay back those bonds that we borrowed up here, that's cash going out. If we buy our own stock, right, treasury stock, that we have to purchase it with cash, that's cash going out as well. There are some activities that are very significant. In other words, they're meaningful to the company, but they do not involve cash. And so these would be reported separately, usually as a separate note or the bottom of the statement, but they're not part of cash flow because there's no cash involved. But your book tells you a bit about some significant activities in which no cash is involved, okay? Sometimes companies buy assets with stock. And so they will issue common stock to purchase land and a building. Well, there's no cash involved in that, and so it's a non-cash activity. Some companies have convertible bonds, and they'll convert those bonds into stock. No cash is exchanged. It's just the bond is being paid with shares of stock, no cash. So that's a non-cash activity. Usually if they issue debt to buy assets, just like here, they issued stock to buy assets. They can also issue bonds to buy assets. Again, there's no cash involved. And in the case that they might need to exchange their plant asset, so they have a delivery truck that they're exchanging for another delivery truck, no cash is involved. And so that's a non-cash activity, but it's significant because you'll see those changes on the balance sheet. Again, these are reported separately and usually on a separate note. They're not part of the cash flow statement because there's no cash that's flowing. This chart shows you that even though companies will have a profit, which is net income, that it's going to be a little bit different. We have to look at cash provided by operating activities as bigger than just the profit of a company. And so here shows the profits of these companies that are listed compared to actually the actual cash that's provided by the operating activities of the company. And as you see, that net cash provided by operating activities, which we're going to be learning about in Objective 2, includes the net income. It includes it, but obviously it's a lot more than just the profit of the company. Okay, and that's what you're going to be learning in Objective 2. All right, so there's a format to the statement of cash flows that's always the same. Operating activities are always listed first on the cash flow statement. Investing activities are listed second, and finance activities are listed third. Okay, and you'll see that on the format here. So this particular format is common for cash flow statements. And this particular one, I'm opening the book to see if I can actually find the page number here. This here is on page 594. So if you have the book and you look at page 594, you will see that this is a common format of a cash flow statement. Okay, so the company name would go first, the statement is the cash flow statement, and then whatever period of time that's covered. Okay, it's usually the same period of time as the income statement, as well. And that's because it starts with the cash flow from operating activities. And so the operating activities are listed first. All the items are listed as we're going to go over in Objective 2. And then in many cases, this should be a number that shows that cash flow from operating activities is good. In other words, it's going to be a positive number, which means there's more cash coming in than going out. However, if you see this as a negative number, which would be the number on the far right, total, that means that they're not generating enough cash to take care of their business, their operating activities of the business. And that's not a good sign. That's just not a good sign. So you'll see positive and negative numbers on the cash flow statement, but they really need, what they really are is, if it's a positive number, it's cash coming in. If it's a negative number, it's cash going out. That's it. The second thing that is listed are the investing activities. Now, in the investing activities, you want to see a lot of cash going out because you want to see them buying property, plant, equipment. You want them expanding. And so I often would like to see this number shown as a negative, because it simply means there's more cash going out for investing activities than coming in. Okay. But not all companies are like that. There are some companies, Sears, JCPenney's, et cetera, that are actually selling more property, plant, and equipment. So they're actually selling their assets to get money to pay their bills. Not a good sign. And the third section here is from financing activities. So again, things that affect the liabilities and equity. And again, this either is going to be a positive number or a negative number. If it's a positive number, that means that there was more money coming into the company from liabilities and equity. If it's a negative number, there's more money going out for liabilities. They're paying down debt or paying a lot to stockholders and dividends, et cetera. When you take all these three numbers together, okay, you'll have something called the change or net change in cash. It's usually going to be, if it's a positive number, that means there's an increase in cash, so more cash came in than went out. If it's a decrease, negative number shows there's more cash used or more cash went out than flowed in. We compare it to how much cash we had at the beginning of the year. We add these two together to get the cash that we have at the end of the year. These numbers you'll see on the balance sheet. And then this is where it stops. There's a separate note for these non-cash investing, but really we're focusing on the part that goes up from here. That does show on a few. Okay, so here we have our do it exercise where we're looking at identifying the cash flow activity. So this here, we sold common stock. And so again, because we sold common stock, we're getting money into the company. It's a financing activity. If it involves equity, the stockholders' equity or liabilities, it's a financing issue. In the second part here, we borrowed money from a bank in forms of a note. Again, this is going to be a liability on the balance sheet. And so this is also a financing activity because it's a liability. Okay. In the third case here, we purchased long-term assets. And so when you buy 2 semi-trailer trucks, it's a long-term asset. If it's a long-term asset, it's an investing activity. And the last two here, we paid employees when we have a salaries and wages expense. That's an expense. That's an operating activity. And here we performed services and we collected cash for that. That's revenue. That's an operating activity. So that's the first thing to sort of understand, and I'm going to stop real briefly here, come back to our main screen, ask if there's any questions on that. We okay following that? That's the easy part. The next part is really the one that you're going to like, huh? You're going to make that face a lot. I'm not sure if you want to practice that face, like that huh face, or I don't know if you contort your mouth in different ways or your eyebrows shift or whatever, but I've been known to make some doozies myself, so one of those things. So this is the part that's totally different than what we have learned so far. Okay, coming up. You ready? Woohoo! All right, put on your seatbelts. Okay, woo! All right, so if you have your book, I think it is, it's good to have and follow along with this because you're going to need to have these references and resources when you're doing this stuff. Okay, so this starts on page 595 and it goes from there. Okay, so page 595 starts learning objective 2. Okay. So again, the purpose of this objective is showing you actually how to prepare a statement of cash flow. And so actually do one, right? There's a couple of methods that are used, but the most popular method, because it's the easiest method to do, is the indirect method. So that's what the book is teaching you, and that's traditionally what we would use anyway, okay? And before you can actually prepare a statement of cash flow, which is a complex statement, you need a lot of information. The three primary sources of information would be a comparative balance sheet, so balance sheets for the last 2 years, okay? Your current income statement. And there's going to be additional information that's necessary for you to understand before you can properly do a statement of cash flow. Okay. So here are the major steps that are involved, and I'll just go through this. This is on page 596. This is a box at the top of page 596. So the first thing we actually have to do is do some conversion, okay? We are going to be converting our net income, which is our profit, from how we created it, which is the accrual basis, to the cash basis. And this really is the real pain in the backside that a lot of people have with the statement of cash flow. This is the part that really kind of gets them. Because for the first time in this entire sequence of classes, Accounting 101, 102, you're asked to do something on a cash basis, and this is the first time you've been asked to do that. So this is really kind of tricky. So you're going to give yourself a little bit of a patience on that, okay? The cash basis only is when cash moves, okay? The accrual basis, as you know, regardless whether the cash is moving, you got to put it down on the record. So there's going to be differences that are tricky. Okay. The second step we're going to be doing is looking at changes in the asset and liability accounts and seeing if there's any financing activities or non-cash transactions that we need to take a look at, because that's also important in preparing the statement of cash flow. And the third thing is we're going to look at the changes in cash from the first year to the second year, because ultimately when we're done with our cash flow statement, we'll explain that difference. Okay, so I've already told you about using the indirect method. There are two methods, direct and indirect. The indirect method is certainly the most popular. It's easy and it's cheap to prepare. Okay, it also focuses on a lot on the cash flow from operating activity, different than the profit of the company. So it looks at the operating activities more deeply, and that's important because that's where almost all the cash is used or saved. So All right, so the first statement, one of the pieces of information you need is the current income statement. And so here is your income statement showing everything from sales revenue all the way down to net income. Notice this is our net income, okay? That doesn't mean that's our cash flow. It's just our net income. We prepared the income statement using the accrual method. The second pieces of information you need are the comparative balance sheets, right? So here we have the balance sheets side by side, information from 2016 and 2017. We are looking for changes in the balances of each account from the base year to the most current year, okay? So here, of course, this is going to be a cash flow statement. So we're going to be able to explain why cash has increased by 22,000 from 2016 to 2017. Remember, this is the balance sheet. This is what we're going to prove on the cash flow statement, how it increased, why it increased. Okay, so that's a very interesting thing. But notice all of the asset accounts in this case are listed with all of the changes from 2016 to 2017 noted on the right side. This is still a comparative balance sheet, so it's still part of that second page. It's just in a different format. The base year 2016 changes to 2017 in liabilities and in stockholders' equity with the changes noted on the right side. Remember, the changes noted, look at the 2016 number, then look at the 2017 number and note the difference. So 2016 started with $12,000 in payable. 2017 is $28,000 in payable. That's $16,000 more. That's the increase. So that's how they're looking at it there. And the third piece of information we need for a cash flow is all that additional information. And here there are 6 little pieces that we have to look at, including depreciation expense, the fact that the company sold equipment and received some cash for that sale. Looks like they issued bonds directly for land, so no cash was involved. Looks like they purchased a building for cash. They also purchased equipment for cash, so there's cash involved there. They issued some common stock for cash, so there's cash involved there, and they paid a dividend, a cash dividend, so cash was involved there. So this is all that additional information in addition to the income statement and the comparative balance sheets that were talked about earlier. It's a lot. This is all on page 597. So page 597 has all of that information all on one page. Okay, the comparative balance sheets, the income statement, and this additional information are all on that page. Okay, the first step is the most difficult one because we are converting to the cash basis, okay? We have all of this information on the income statement that was done on the accrual basis, and now we have to take all that stuff away. It's a real pain in the backside, okay? So we start with net income or net loss, but we have a very happy textbook, so everything is profitable. Amen, hallelujah. And we do 2 things, okay, 3 things, sorry, can't really count today. First thing is there are some expenses that we subtracted out that are not cash. There's non-cash expenses. The biggest one we know, depreciation. Depreciation expense, you don't have to write a check. Rent expense, you're writing a check. Salaries and wages, you're writing a check. All the other expenses, you're writing a check, basically, cost cash. Depreciation does not cost any cash. So we have to add that cash back in because that cash never went out. The second thing we have to do is reverse any gains and losses, because you remember on the multi-step income statement, there's that other section. And that other section, we add in other revenue or gains. We subtract out other expenses or losses. We're going to add those. We're going to reverse that. So the second step is reversing those. And the third step is probably the most time consuming and confusing, is changes in current asset and current liability accounts need to be noted to see if they actually required any cash. Okay. If there wasn't any cash used in the changes in the asset or liability accounts, then we have to add that cash back in. If there was cash used, you have to subtract it out. So that's where it gets a little bit tricky. Okay. So one thing you have to understand too is this, we're looking at operating expenses. So everything that would be on the income statement, right? So which would be an example of an operating activity? Okay. Well, they say A. Why? Well, because when a company pays interest on a loan, the interest is expensed. So the interest expense would be on an income statement. And so it's an operating activity. Okay. That's different than getting money from issuing stock, because that's a financing activity. That's different than paying dividends, because that's also a financing activity. But when we pay lenders interest, the interest can be expensed, and so it's an operating activity. The loan itself is a financing activity, but the interest on the loan is operating. Okay, so if you remember, like I mentioned very early on, we had net income of $145,000 for computer services company when I was showing you the statements. The very first statement was the income statement. It's on page 597, and you see the income statement showing net income of 145. So that's where that number came from. Remember, the very first thing that we do is add back depreciation, because depreciation is not a cash flow thing. We don't write a check for it. Okay, so we are simply adding back the depreciation to the net income. Okay, because this did not use any cash. The second thing we have to do is reverse any losses and gains. Okay, so if we had a loss, we subtracted it from our income statement. Well, we need to add it back. If we had a gain, we added it to our income statement. Well, we're going to take it out. Okay, so we're just reversing the gains and losses. Now, in this case, the only thing this company had was a loss on plant assets. Well, that loss was taken out of the net income, so we're going to put it back. Okay, and that's technically because it didn't cost us any cash. Now we look at changes to non-cash current assets. So these are current assets that are not cash, right? So the first thing they look at here is accounts receivable, right? Accounts receivable is when we were expecting cash in from customers, right? We've already given them a service. We're waiting for their cash, basically. It's accounts receivable. So if you started accounts receivable with $30,000 balance, and you received a lot of money from the customers, and now your balance is only $20,000, well, that means that you had $10,000 of cash coming in to lower your balance, right? $10,000 more coming in gives you a lower receivable. So we have to add that cash into the net income. So again, a decrease in receivables means we've received the cash. So we're adding the cash to our cash flow statement. Inventory, right? Usually when we buy inventory, it takes cash, right? So our inventory here went from $10,000 at the beginning to $15,000 at the end. So we had to take $5,000 more of cash to buy this inventory. And so we're going to take it away. We're going to reduce our cash flow for this increase. So the increase in inventory means we have to use more cash to buy it. And so we reduce our cash flow by that, okay? The negative number here simply means our cash going out. Positive number simply means cash coming in or staying in. Okay. And then we look at these other things like prepaid expenses. So it could be prepaid insurance or prepaid rent or whatnot. So basically speaking here, when your prepaid expense balance increases, right, you have more prepaid insurance, it's because you probably paid more cash for it, okay? And so you have to take that away from your cash flow because you have less cash. However, if prepaid expenses are going down, you probably saved cash and you would add it. So in this case, the increase in a prepaid expense like prepaid insurance meant very likely you had to use cash for it. And so that means you have less cash here. So we reduce it, we take it away on our cash flow statement because the cash flow statement only looks at cash. Okay. Changes in liabilities. Now, when accounts payable means that we owe cash to other companies. Okay. So basically, when we have more payables, we owe more cash to other companies. Well, that means we kept the cash in. We didn't put the cash out yet. We owe more to companies, but our cash is, we have more cash. The cash stays in. So an increase in a payable means we have more cash in the company. So it's going to be added. The opposite of true when a payable goes down. It meant that we paid bills down, and the only way you pay bills down is to pay cash. So anytime those payables go down, it meant you used cash. And so you're going to subtract that cash flow out. So here we had an increase in accounts payable, which meant we didn't pay the cash out. So technically the cash is in the company. So it's added to the cash flow statement. And here we have less of a liability. Income tax payable is less. So if we have less of a liability, we must have used cash to pay it down. And so we have less cash, so they get subtracted. Okay. So this is our net cash provided by all the operating activities. See how different it is from just looking at net income or the profit. Okay. And this is the most difficult part of this cash flow statement, because everything we've done in all of these adjustments is ask the question, did we use cash for it or did we save cash from it? Okay. If we saved cash, it's added to the cash flow statement. If we used cash, we subtract it from the cash flow statement. This chart is pretty handy because it actually goes through all three major issues that we just looked at, okay? And it tells, so we only use depreciation. We don't have the other ones. So depreciation expense, we reverse the losses and gains. And then we change those current assets and current liability issues as we just went over them.
That does look really useful.
Yes, it is very useful. All right, so this is on page 602 and 603. And so it's important that you review this because this is something you're going to have to do. It's a practice of what we just did. Okay, so in your textbook, page 602, 603, the do it exercise is 2A, and it simply looks at what we just focused on, net cash from operating activities. So here we have a company, Josh's Photo Plus company. They have net income of 73,000, right? Looks like they have a depreciation expense. They have a gain on disposal of assets. And then here are the comparative balance sheets for 2016 and 2017. And what we have to do is note the changes from the base year to the current year as either increases or decreases in the account, because that's going to help us calculate the net cash provided, right? So the very first place we always start when we do this is we start with the net income of 73,000, okay? That's always the starting place. Whatever the net income is, this is the starting place. Remember, we are going to add the depreciation expense in because it didn't take out any cash. The cash stayed in. We didn't write a check. So we add the depreciation expense to the net income. We have to reverse out the gain. So we're going to subtract out the gain of this $2,500, right? Because we have to nullify gains and losses because they tend to be gains and losses based on book value and not on cash. And the last thing we have to do is note the changes in the account. So here we went from 17,000 in accounts receivable to 21,000 in accounts receivable. Our accounts receivable increased by $4,000. The question would be, with the increase of accounts receivable, does that mean that we actually, it cost us cash or it saved us cash in this case? Well, any increase in a current asset means basically it cost us. And so we would take that away. In the accounts payable department, we have less money here, okay? Less money here. And so in this case, we went from $6,000 of payables to 2,200. The only way you get payables down is to use cash. And if you're using cash, you're going to take that away as well. So what you have here is the solution to the do it exercise problem, right? You start with the net income. We're going to reverse, we're going to add back our depreciation expense. We are taking away our gain because we're reversing our gain. Increase in a current asset is oftentimes means we had to use cash to do it, or we gave up cash to do it. And the same thing with payable. If our payables go down, we had to use cash. So we had $73,000 of net income. When you combine all these numbers, it meant that we used up another $3,300 of cash. So our net cash provided by operations is listed there at $69,000. So this is going to be, and I'll stop the screen share for a moment and come back. That's going to be the most difficult part of all of this, okay, is finding out uses and getting provided cash. You know, it's just a different way of looking at the cash flow statement's a very different way of looking at the world. Like I said in my other class the other night, it's like being on Venus when you're so used to being on Mars. It is like so different how it's looked at and how it's analyzed. And I know I'm asking you to do that for the very, very first time from a cash basis. So you got to give yourself a little bit of a, you know, pat on the back, you know, don't slap yourself too hard, but just, you know, just understand that this is something that you'll get used to over time. You're going to see it again in managerial accounting. It's a very important statement for businesses. It's one of the more important statements, but it does take a lot of time and experience to kind of understand it. All right. So the operating activities is the busiest part of the cash flow statement. It's the busiest part. The other two parts are relatively straightforward, and we're going to do those now. Okay, so we're going to look at investing activities and financing activities, okay? And so we had a whole bunch of activities that were happening. Remember, this company bought land by issuing bonds. So as you see, the land account increase and the bond payable account increase. There was no cash involved here, so it's not something we need to worry about. But as you probably do remember, they purchased a building for $120,000 cash. This is part of that additional information. So in this case, purchasing a building did affect cash. It was a use of cash. And so you see cash with a negative sign around, only indicating that the cash went out. It's a use of cash, okay? Another thing that the company did was purchase equipment. Here you have a purchase of equipment with way too many zeros. Someone was excited. You know, and that was a cash transaction, okay? They purchased equipment for cash. And so when you looked at this, I'll go back here, the equipment for $25,000 cash was a cash flow of going out for the purchase of equipment. Again, it's property, plant, and equipment. Building and equipment, property, plant, and equipment, that's an investing activity. Those types of assets are investing activity. The last thing that's kind of weird is they sold some equipment, okay? So they sold equipment for $4,000. Now, this $4,000 is important because that's the cash coming in. The equipment originally cost $8,000. With depreciation, had a book value of $7,000. So we know that they took in $4,000 of cash for the sale of this equipment, okay? It was an $8,000 piece of equipment that had $1,000 in accumulated depreciation. So when you reverse that out, you'll see that the loss in this case is $3,000 because the book value of the equipment would have been $7,000, right? They got $4,000 cash. The loss is $3,000. Well, this cash is the important thing that we need to know for our cash flow statement. And as you see, it's very teeny, tiny. Hang on now. Because it shows two things. It shows the cash coming in from the sale of equipment under investing activities. And it shows that $3,000 loss being reversed up in operating activities. Okay, so that's where those numbers came from. The next thing that we had here looks like a financing activity. They increased shares of common stock, right, by $20,000. That $20,000 coming into the company means that it's a positive cash flow. Cash coming in is a positive number. Okay. They also paid dividends of $29,000. So dividends is a cash dividend. That's going to affect cash. So we need to focus on the fact that cash went out of the company to stockholders. And that, as listed way down here, is a financing activity because the money went to stockholders. Okay. Okay. So let me actually bring my eraser here because I want to show you something important. Well, not that anything else is important, the whole thing, but so I want you to know that starting from the net income, all of these numbers for operating activity gives us this number here. This number here is a positive number, so we say it's cash provided, so cash coming in. The investing activities show cash going out, so we show this as a use of cash. Cash is being used, okay? And financing activities show more money going out than coming in, so this is cash used by financing activities. When you start with the 172, you subtract out the 141, you subtract out the 9,000, the difference is 22,000. Okay, so the change in cash are these three numbers combined. Okay, so the $22,000 change in cash meant that we actually had $22,000 increase in cash. More cash came in than went out by 22,000. Okay. So the cash at the beginning of the year was 33,000. It increased by 22,000. And so the cash at the end of the year is 55,000. This is on the balance sheet. Okay. All right. So the net change in cash is what I just went over with you. I did a little bit early. Again, when you looked at the balance sheet for this company, you saw the cash account line here. For 2016, it was a $33,000 cash balance. But for 2017, it was 55,000, up by 22,000. We just showed that. And that is the deal. Okay, so I have this taped, I have this recorded. I'm going to stop